The Rule of 72. How to double your money. What if I told you there's one simple number that can predict exactly when your money will double? No guesswork, no advanced math, and no risky investments required. This number has been around for over 500 years, and once you understand how it works, it'll change the way you think about money forever. Most people believe wealth is built through spreadsheets, stock picking, or some hidden formula. But what if all you needed was a basic shortcut? That shortcut is called the Rule of 72. It's a timeless hack in personal finance that makes compound interest easier to understand and more powerful to use. So, what is the Rule of 72? Many people think building wealth requires complex tools, a finance degree, or a mountain of spreadsheets. But sometimes, it just takes one simple shortcut, the Rule of 72. This rule helps you estimate how long it will take you to double your money with compound interest. Here's the trick. Take the number 72, divide it by your annual return rate, and boom, that's your timeline. For example, let's say your investment earns 10% annually. 72 divided by 10 equals 7.2. That means your money doubles in about 7 years. At 6%, it takes 12 years. At 20%, just 3.6 years. It's not magic, it's math. And it proves just how powerful compounding can be. But the real lesson behind the Rule of 72 isn't just about how fast your money grows, it's about the power of time. Here's why it pays to start investing early. Let's compare two people, Chris and Derek. Chris starts investing $300 a month at age 25, earning an average 10% return. He keeps this up for 30 years. Derek waits until he's 35 to start. To catch up, he invests $500 a month for 20 years. Same return rate. Now here's the wild part. Derek invests more money overall, $120,000 compared to Chris's $108,000. But Chris ends up with $619,000, while Derek only has about $359,000. That's a difference of almost $260,000, all because Chris gave his money more time to grow. The reason? Time is the multiplier. The longer your money compounds, the greater the outcome, and you don't have to increase how much you contribute to see massive growth. You just have to start early. But what's the cost of playing it too safe? If your money sits in low-yield accounts like regular savings or CDs, the Rule of 72 turns from a superpower into a trap. Let's test it. Savings account at 1%, 72 years to double. Treasury bonds at 5%, 14.4 years. S&P 500 average return of 10%, 7.2 years. Real estate at 8%, 9 years. Bitcoin at 90%, last 10-year average. Less than 1 year, but a high risk. The higher the return, the faster the doubling, but you also need to understand volatility. Which brings us to the next point. The compounding curve. Doubling once is exciting, but the magic really kicks in when it happens again, and again, and again. Let's say you start by investing $10,000 at 10%. After 7 years, you'll reach $20,000. After 14 years, $40,000. 21 years, $80,000. This is all based on a single starting point, no extra investing. Just time plus return equals exponential growth. This is how wealth is built quietly, not through flashy trades, but by letting compounding do the heavy lifting. But wait, what if inflation steals the power of your dollars? Let's say your investment earns 6% interest, but inflation is running at 4%. Your real return is just 2%, which means the time it takes to double is far longer than you think. Inflation isn't obvious. You don't see it on financial statements, but it's eroding your purchasing power every day. That's why smart investors aim for returns that outpace inflation, not just beat the bank. Now let's discuss how interest rates can boost your returns. When you understand how interest rates work, it can change your whole outlook on investing and wealth generation. For example, let's say you buy a $400 bond that pays you $1,000 in 10 years, with an implied return rate of about 9.6%. If interest rates drop, your bond will become more valuable because newer bonds are paying less. This means that you can sell it early at a profit, without even waiting for maturity. However, when interest rates rise, the opposite happens. Your bond's value drops. That's how some investors make big gains without waiting decades. Rates affect everything, bonds, stocks, real estate, because they change the value of future cash flows. Understanding interest rates lets you anticipate these changes instead of just reacting to them. Want bigger gains in less time? That's where asymmetric bets come in. An asymmetric bet is when you take a small portion of your portfolio and put it into high-risk, high-reward assets like Bitcoin or early-stage stocks. These bets are risky, but the upside is massive. You can only lose what you invest, but the potential gain could be up to 1,000% or more. That's how even a 1 to 2% allocation to Bitcoin, if held long-term, can dramatically shift your overall outcome. But be careful, it's not about hype, it's about risk management. Okay, let's sum everything up. Here's the truth most people never learn. Wealth doesn't just come from hard work, it comes from how you think about time, growth, and money. The rule of 72 isn't just a formula, it's a mindset. One that values strategy over shortcuts, patience over panic, and structure over speculation. Every dollar you invest is a silent worker. It never sleeps, never takes a sick day, and never asks for a raise. That's why you should start investing as early as possible and use the rule of 72 to help you grow your wealth over time. Once you make this mindset shift, wealth building will become inevitable. Thanks for watching. If you liked this video, be sure to share it with others and subscribe to my channel for more tips on building your financial future. What are some tactics you have used to grow your wealth? Let me know in the comments below. See you in the next video.